Every major Bitcoin rally looked obvious, but only after it already started. Before every big move, one specific on-chain metric quietly signaled what was coming, while most people ignored it. Price didn't give the clue. News didn't give the clue. The data did. Most crypto investors experience rallies the same way. They notice them late. They chase momentum. They buy when confidence feels highest. Then the market pauses or pulls back, and suddenly the excitement turns into stress. Later, when they look back at the chart, they realize something uncomfortable. The rally didn't come out of nowhere. I just didn't know what to watch. Institutions don't rely on hindsight. They rely on leading indicators. In this video, I'll break down the on-chain metric that has historically preceded every major rally and explain why institutions trust it more than price action. We'll look at how it works, what it measures, and why it consistently turns bullish before momentum appears on the chart. This isn't a prediction tool, it's a context tool, and that difference matters. If you want data-driven crypto insights instead of emotional speculation, make sure you're subscribed. This channel is built for investors who want to understand the market, not react to it. Core idea: price moves last. Retail believes price leads. Institutions know price follows behavior. Before any major rally, participants change how they hold, move, and store Bitcoin. Those changes appear on-chain first. Price reacts later. That's why this metric matters. The market doesn't move when people get excited. It moves when positioning is complete. THE metric. Supply in exchanges. The on-chain metric institutions watch closely. Is Bitcoin supply held on exchanges? It sounds simple, but its implications are powerful. When Bitcoin moves onto exchanges, it usually signals intent to sell. When Bitcoin moves off exchanges, it usually signals intent to hold. Over every major cycle, this metric has told the story early. Why institutions care about this metric? Selling requires liquidity. Liquidity lives on exchanges. If Bitcoin is leaving exchanges, sell-side pressure is quietly shrinking. That doesn't
Why it
cause
consistently
instant
turns
price
bullish
jumps,
before
but it
momentum ever
creates
appear on the
structural
chart.
support.
This isn't a
Institutions
prediction
don't
tool,
need
it's a
price
context tool,
confirmation
and that
when
difference matters.
supply dynamics already favor them. Rallies don't start with buying pressure. They start when selling pressure disappears. Historical context. What happens before rallies? Before every major rally, exchange balances trend lower for weeks or months. This happened before early bull market expansions, post-bear market recoveries, continuation rallies during strong cycles. Price often stayed flat while this happened. Sentiment remained uncertain. Institutions were accumulating quietly. Why retail misses this signal? Retail looks for excitement. This metric feels boring. It doesn't spike. It doesn't go viral. But institutions prefer boring signals because they're harder to manipulate and slower to reverse. Retail wants speed. Institutions want reliability. If a signal feels boring, it's probably important. Supply drains actually form. Supply doesn't disappear overnight. It leaves exchanges gradually. Withdrawals to cold storage. Long-term custody solutions. Institutional holding wallets. This process creates no headlines, no hype, no obvious price reaction, but it changes the market's foundation. Why price stays quiet during this phase? Accumulation absorbs selling. It doesn't push price up aggressively. As long as supply is still available, price stays range-bound. Only after supply becomes scarce does demand start moving price. Institutions understand this sequence. Retail usually doesn't. If price hasn't moved yet, that doesn't mean the setup isn't complete. This metric filters false signals. Many indicators flip bullish and bearish constantly. Exchange supply trends slowly. That slowness is its strength. It filters noise. It filters emotion. It filters short-term speculation. Institutions trust slow metrics because they reflect real decisions, not reactions. Why this metric has predictive power. It doesn't predict price. It predicts behavioral shifts. When large holders decide to stop selling and start holding, the market changes fundamentally. Price eventually reflects that change, not the other way around. Markets move because people change behavior. Not because charts say so. HOW institutions use this metric. Institutions don't act on one data point. They watch trends. They watch consistency. They watch confirmation over time. When exchange supply trends down, while volatility compresses, they start positioning. No rush. No hype. WHY retail enters TOO late. Retail waits for green candles. By the time price breaks resistance, exchange supply has already declined significantly. That's when institutions shift from accumulation to risk management. Retail calls it the start. Institutions call it the middle. Confirmation feels safe, but it's expensive. What this metric does not do, it doesn't give exact bottoms. It doesn't tell you the day price will move. Institutions don't need precision. They need probability. This metric improves probability, not certainty. Supply leaving exchanges doesn't guarantee immediate upside. Macro conditions still matter. Liquidity can tighten. Institutions manage this by scaling entries, diversifying exposure, controlling position size. Retail fails by going all in emotionally. HOWYOUC and use this metric correctly. You don't need complex dashboards. Is supply trending down over time? Is price stable or compressing? Is sentiment still uncertain? If yes, conditions favor accumulation, not distribution. WHY this metric works across cycles. Human behavior doesn't change. Fear causes selling. Confidence causes holding. Exchange supply captures that behavior directly. That's why it continues to matter. Cycle after cycle, technology evolves. Psychology doesn't. Every major rally felt sudden, but none of them were random. Before price moved, supply shifted. Before excitement returned, selling pressure disappeared. If you learn to watch what participants are doing, not what price is showing, you stop reacting late and start understanding early. If this breakdown helped you see the market more clearly, subscribe for more data-driven crypto insights, and I'll see you in the next one.